Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for the Monday edition of Trader Talk in today's market. I'm your host, Kevin Horner, coming to you from a shockingly snowy Denver, Colorado this morning. As it turns out, I am pleased to be joined by my friend, Mr. Jeffrey Avalos, everybody. Great to have Jeff back. We get Jeff about once a month here on the show. Jeff, how you doing this morning, buddy?
A lot better now that I'm here with you, Kevin. Thank you very much for having me on the show. Hello to all the viewers. Glad it is snowing in Denver because I tell you what, buddy, there has not been a heck of a lot of snow happening this year on the western part of the country. So
Yeah.
kudos to you for getting to do a little snow shoveling this morning. How's
That's
everything going?
true. I'm shocked, to be honest. I woke up yesterday and with no belief, no knowledge of a impending little snowstorm, and that's exactly what we got. So we'll take all the precipitation we can get, no matter how it comes to us out here. So we've had a hectic couple of weeks, to say the least. We are entering now week 3 of the Middle East conflict, depending on how you choose to title that, and yet the market remains volatile. So we're going to talk about a number of key aspects of the market this morning. Of course, we are joined by Brent Moores in the chat. You can say hey to Brent, who monitors stuff for us there, of course. Get the comments and questions that Jeffrey and I are unable to, but we're going to keep an eye on things, try to bring your questions to the discussion where we can. So please feel free posting in there for our duration of the show. Remember to follow us on X, and remember to be subscribed to the YouTube channel we call Trader Talks, everybody. And then finally, if today's conversation works out well for you, if you like the content, like what you get from Jeff and my discussion with you, then hit the thumbs up button for us down below, because we archive these, make these available for later viewing for all of you, and that thumbs up helps us out quite a bit in the replay process. So with that, let's get to our disclosures, and then we'll dive into the chart. So first, please remember that everything we discuss today is considered informational and educational exclusively. What that means simply is we do not make recommendations nor endorsements for any approach to trading the market here. What we will do, however, is discuss technical analysis. We'll bring concepts and strategies that traders will choose to employ in their own processes. We bring those to the analysis we offer you as we review these groups in the market. Remember, though, technical analysis, just one of your decision-making pieces, not the entirety of it. As far as our agenda, we work in a broad-based manner, a top-down filter, if you will. What that means, we start with the biggest indices, our S&P 500, our NASDAQ 100, the Russell 2000. We'll work into sectors and industry groups as well, plus a few stocks in the news on the move this morning. So with that, let's get to it. By the way, Jeff, you know, it's NVIDIA conference week as well, so we're going to kick things off with the S&P, where we usually do. The big takeaway for many of us, Jeff, hey, it's been rough, it's been rocky, it's been tricky, and yet price action remains above the 200-day moving average.
I'm noticing that. And one of the things that Kevin and I, to the viewers out there, were discussing before the show was I've been traveling around a lot these last few weeks. So it's been very, very difficult for me to watch what's happening in the market. So what you're getting here as I'm looking at this is a fresh set of eyes. So I'm seeing this for the very first time, really doing a deep dive analysis that I've done in at least a month, Kevin. So as I'm looking at the S&P 500 right now, what jumps out to me? 200-day simple moving average. First and foremost, we've broken below the 20, we've broken below the 50, 20 has crossed below the 50. If you're worried about some short-term bearishness, well, not one. But that 200-period simple moving average, Kevin, that little bounce and hop that we're seeing this morning is probably going to garner a lot of attention from traders out there. What are we thinking moving forward? Ultimately, it's going to be, let's let the trend decide. Do not try to jump ahead and say, oh, because we bounced off the 200, we now have to go below it, or because we bounced off it, we have to stay above it. Most certainly not. Anything can happen. So what could you look to do in this environment, Kevin? If you're somebody who is bullish, what you may wait to do is see if we can get another drop and stop on that 200-day simple moving average. If you can hold that for, let's call it 3 or 4 bounce periods, 1 day it holds, 2 days it holds, 3 days, 4 days, then you might have a pretty strong support level there. In this case, Kevin, all we've got is one bounce at this point in time. And with the conflict in the Middle East happening in the Strait of Hormuz, that could be very, very challenging for the markets overall, not just here in the United States, but internationally.
I definitely agree with everything you've said, Jeff. And I think that the biggest challenge that many of us traders are dealing with is the sentiment that seems to change on a dime. You will be bullish in the morning as we have a nice little open, and that sentiment leads you to feel confident. And this is where, Jeff, I think it's very important that traders be reminded of our challenges as humans. And what I mean by that is so much of the decision-making difficulties we traders experience, it's not specific to us as individuals, but much more likely specific to us as humans. We have this cognitive bias as it relates to trading and the way that we want to trade. We feel good about buying on days when the market is up, Jeff. You see green on the screen, you're led to believe that things are great, you want to buy. Great. But when things are rough, we feel like, okay, it's time to sell. We need to be capable of challenging those scenarios a little bit. And what I mean to get to, Jeff, is we have to look at the longer term thought process. So yes, we have a 200-day moving average holding up quite nicely. If I go to the weekly, we notice the 40-week moving average holding up quite nicely. But Jeff, we have to be prepared that things are changing potentially. And if we go back to my daily, Jeff, if this is a new scenario under which we've had weakness over the last 4 to 6 weeks, that 20-day moving average matters for us. Take a look at how we have this rounding of our price action at the upper level up here. Now, I don't have the benefit of arcing my lines, right? But if you notice here, this is kind of what I'm talking about, right? And you've got that 20-period moving average. We've been by and large below it all the way back to early February. So bounces into the 20-day, Jeff, have for the last 6 weeks been sold. Do we need to bear that in mind in as we look at today's little bit of optimism here? I mean, yes, we've got oil lower than it was at the peak this weekend, but does that mean we've had a shift to the true story of what's happening globally, internationally, as it relates to oil, et cetera? I don't know that we have.
Yeah, I agree with you completely. The hard part for everybody out there who's bullish is you've got a lot of headwind out there. You've got not only what's happening in the Strait of Hormuz, but you also have what's just a general softness in the overall market. People are saying, well, the mortgage rates aren't doing as good as they were. All right, we're getting a little bit more concerned about the unemployment and some of those announcements that are coming out. All of that tends to weigh heavy on the sentiment of the overall market. It's not until you have an earnings announcement or you have a CPI or a PCE number come out that you start to see some real change affected in the market. As of right now, Kevin, I think the story is what a lot of traders are looking at, and it's very difficult to find a bullish argument in that story, big guy.
It really is. And I think that's the reminder we want to offer traders today. We are getting a bounce. Let's temper our enthusiasm to a certain extent and see if what we're getting is a bounce that is trend changing, short-term trend changing, because our long-term trend for the most part remains held here, although we are at very important levels as we just saw on that weekly, that 40-week moving average, Jeff. The reason I brought it up is when you remember one of my favorite little axioms is about the idioms about the market is we trend until suddenly we're no longer trending. So if I show, for example, let me lift off that green 20 period and just look at the 40-week. Yeah, we could find horizontal support slightly beneath us at around 6,500. But Jeff, there's a really long range look of support between 6,000 and 6,100 here on the SPX. And I think that is an entirely reasonable level to which the S&P could retreat and find a bounce. And the truth of the matter is, Jeff, as we get under that 40-week moving average, if that were to occur, the likelihood of a deeper retreat to that ledge becomes increasingly potentially likely.
Yeah, especially coming into the summer months, Kevin. I think you're absolutely right on that. And what we're talking about here to the viewers also, during the summer months, you're generally seeing weakness. So if you compare the returns of the 6 months over the summer versus the 6 months over the winter, you get somewhere around a 1.2% average return over the last 20 years versus a 6.6% average return. The numbers are somewhere in there. But the fact that that sell in May and go away adage is out there does actually hold true. Now, yes, it is time in the market versus time in the market because the average return over an entire year period is about 11% over the last 20 years. So coming into a known period of historical weakness, that can draw a little bit of trepidation from a lot of traders out there. So, Kevin, as you said, what are people going to be keeping their eyes on? support, support, support. If it can hold these supports, then maybe folks say, all right, I'm comfortable staying in this market. If it can't hold that support, I would be very, very careful, because if you start seeing a break, that could be where everybody says, you know what, I don't think I want to be in this theater anymore. This movie
Mhm.
isn't fun. I'm going to start heading for the exits.
That is very much commonly the process, right?
Uh,
Okay, Jeff. So we've got a 1% open on the S&P 500. We'll see if it's more than just a optimistic short-term bounce. Let's see how the Nasdaq is managing it today. We're up about the same thing, 1%. Struggling in this space now. I've been calling the 50-day more likely our moving average of resistance in this scenario. I've called this out for the last 5-6 weeks or so. Notice how we've been really, this is pretty obvious, right, Jeff? I mean, it's pretty
yeah,
clear
a
the
lot.
moving average above which we can start to suggest once again, maybe the NASDAQ is in trend. It's not in trend right now.
Well, certainly not in a bull trend. This is more of a bearish movement.
Fair.
And remember, everybody, we just went through earnings announcements. So this is a digestion after the fact of an earnings announcement, letting you know that the market is just not ready to start moving above that 50-period simple moving average. We do still have a few more earnings on the docket, but Kevin, I think what we 85, 87% of the way through with the earnings season, not a whole
Mhm.
heck of a lot of potential for these last folks to give some strong movement or a giant pop, call it 5, 7, 8% coming in the next couple of weeks. So yeah, as you look at the NASDAQ here, you see some weakness. But the good news is, Kevin, it's not weakness to the point where you say, oh, this is an impending recession. I don't think that that's what's happening here. I think it's just more of a sideways movement. So you've got the resistance up there at 26,000. You've got support probably forming somewhere around 24,000. Keep your eyes on this sideways movement. The market can move
Sure.
sideways for quite some time without having to drop down and say, okay, uh-oh, now it's time to get this recession over with. So just because we're moving towards the bearishness of the market does not mean that we are then in a bearish market. Careful of that.
That's true. Yeah. Remember the trends we can see. We can see uptrends, we can see downtrends, and we can see sideways trends. What matters, of course, is the time frame we apply to all of that. Here, it's pretty interesting, as you called out, Jeff. Yes, the 200-day is right beneath us, a very long-range supporting moving average. We have basically tested it 3 times in the last 2 to 3 weeks here, which kind of validates that ledge for support. We'll see if we continue to maintain it. Some traders would tell you that you've got a little bit of a bullish divergence here, Jeff. I'll just note that our lows in here have been lower in actual price, but our highs in RSI, our lower highs there, kind of validate potentially support maintaining here. So some traders would look at that and say, all right, I'm going to take that as optimistic, right? It's too early because we want price action to dictate everything we do more than trying to predict from what we get in the way of technical analysis. Remember, technicals don't do a great job of telling you what's going to happen. They just tell us the best way to set our risk. As it relates to the NASDAQ, Jeff, I think the takeaway is, all right, we will change our tolerance for risk with a close or two under the 200-day moving average.
Yeah, yeah, really well said. Good call out, by the way, on that divergence of the RSI.
Well, you need them sometimes. When you're struggling, you're looking for divergences, right? You're looking for
So
reasons to
true.
be bullish, and our balance
Yeah.
is try not to let that bias lead my decision making, right? So that could be just as good. The other thing, as Barbara's mentioning, the RSI has actually, I think this is what she's mentioning, the RSI has been downtrending for a while, which kind of validates the sideways action we've seen in the NASDAQ 100. And reminder, the market, when we get big price moves to the upside, we need time to digest those big moves to the upside. I've pointed this out a few times, but we go back to that April 7 Liberation Day bottom, and to the point where we stopped our rally. It was a 57% pop over the course of 140 sessions. That's not a long time, everybody. That's 7 months, Jeff, of uptrending speedily, and we need time to digest that kind of momentum-based move.
Yeah, yeah. Keep in mind, again, as I mentioned before, average movement over a 12-month period is about 11%. That is a
Yes.
57% movement over a 7-month period. That is a very short time. And you're right, you got to digest that sort of thing, not to mention everything else that's happening in the market. Not unusual. By the way, I want to give a quick call out. saw some of the viewers, and we do read your comments throughout the entire show, by the way. Thank you for the donut call outs for me. Taco call outs for Kevin. Kevin loves tacos. All right. So let's just give a little bit
Yes,
of personal
sir.
effect here. We were in San Diego. Kevin found a taco shop. It was absolutely delicious.
Wow,
And he
that was
was on
awesome.
point with all the commentary. If you want to know what a good taco is, this young man can find it for you, Kevin. Well done, big guy.
I don't know who this young man you're referring to is, but nonetheless, we had a great lunch that day before
Yeah.
doing an event in one of the local branches there at Del Mar. It was awesome. I'll tell you, tacos in San Diego, man, those things go hand in hand. We also see that
Sure.
somebody Sam requesting Mr. Fib. Thought we'd throw that up for you
Yeah.
there,
There we go.
everybody. That horizontal level of support coming in around 23.9, just below the important 24,000 level you mentioned, Jeff. You know what? That's one of those deals wouldn't be terrible to see, would be one of those weak opens where we started the morning down there at 23.9 or even below it, and then buyers came in and said that's our flush move. We got below a certain level, we wanted to be in, they got that level, and then they started stepping in. That would be a pretty instructive scenario were it to play out that way. But that's not yet. But as always, I often reminded us we need to be thoughtful about what could happen for us as we go forward, and thinking about all the things that could play out gives you an opportunity to be prepared for those things should they actually play out. So an important level there at the 23% retracement on the NDX. Jeff, let's look at the Russell. Russell's having a good bounce today, 1.6%. It's been under the most pressure due to the inflationary risks associated with higher oil. I'll remind you all, higher oil, there's no way around it. It is an inflationary part of our discussion. So higher oil weighs on your small caps due to those inflationary pressures. Jeff, what else are you seeing here on the chart here as it relates to small caps?
Well, the sensitivity really is what I'm noticing, Kevin. In that circle that you had there, that's probably
Yeah.
about the time where small cap said, okay, this oil situation is going to be a problem for us. And you see the market fall right below that support level that you have drawn in there, giving credence to exactly what you were saying. Oil can be an inflationary pressure when it's rising. Now that we're coming down here, that horizontal line, I've noticed that's formed a little bit of a support there at what's that, 2464 or so. I don't know that
Yep.
this is where it says we find our support longer term. I have to imagine for a lot of traders out there, that blue line, that 200 period simple moving average is giving a lot of attention. So what might start to happen? People might start to say, this is where I'm going to put in my limit order. Okay, so then you don't have a bunch of buy orders at that 2450, call it level. They have the buy orders in at 2400. Okay, well, who's going to keep holding this thing up if nobody has buy orders in at 2450? That's the real question, I think. And if you don't have buy orders starting to come in at that level for a very long time, where does that next level come in? 2400. So, Kevin, I think that might potentially be a short-term support level for a lot of traders out there looking at that 200 period simple moving average as a more hardened level going forward.
I think so as well. And of course, Jeff, we can't look at the Russell without considering the rate situation. The other overhanging risk factor as it relates to the Russell is the fact that we've seen a decrease in the expectations for rate cuts this year, Jeff. We were looking at the beginning of the year, 2 rate cuts between now and the end. And as we go further down the road, it seems like rate cuts become less and less likely, depending on how you choose to look at the way that traders are positioning for it. So Jeff, this is definitely having an impact too. But today, notice how the 10-year yield is being pushed back a little bit. So we're selling U.S. Treasuries, yield is dropping, and therefore you're having a little bit of a lift in the small caps, it would seem. So we'll take what we can get in that way. The bigger move maybe today of everything we've seen is the move in the volatility index, Jeff. The VIX really coming back to earth. Now, one thing that's that I've been doing, and this is just as a means of understanding trend, everybody, I'm going to bring a grid over here real briefly, and I'll mention that these are all symbols that are futures specific symbols. So on the left, we've got the S&P 500 futures, we've got the VIX futures in the middle, and then oil futures on the far right. Now remember, futures trading, these are not appropriate for all of us as investors. You'll need to be familiar with the risk and disclosure statement for futures as well as options, and you need to be approved prior to trade them at Schwab. But I'm bringing it up, Jeff, because I think that if we're trying to understand where we can maybe visually see our risk as it relates to oil and volatility applied to the inverse relationship of the futures in the S&P 500. I think it's a pretty insightful viewpoint here. Your thoughts?
Yeah, I loved it. So, Kevin, to the viewers out there, he showed me this just before our broadcast this morning. I said, "Bravo! These are the three things I think a lot of traders are really paying attention to: the S&P 500, oil, and the volatility index." So, you're right. What you're noticing is as the VIX comes down, as oil comes down, the S&P goes up. Flip that around. If the S&P is coming down, naturally you're going to see the VIX come up just by way of how the contracts are made. And then most likely, if the S&P is coming down, oil is probably going up, giving credit to, we're a little bit worried about what's happening in the Middle East. Oil prices are coming up. OPEC is not going to be able to do enough to keep these things deflated. So really good call out here, Kevin. I absolutely love this. The other thing I've noticed too, is we're looking at the VIX, is over the longer period of time, the S&P 500 was moving down a little bit slower, almost in a slightly sideways movement. That VIX, though, that was coming up. That was hitting higher lows and higher highs. Concerning if you are somebody saying, "Hey, wait a second, what's happening here?" The S&P 500 mostly sideways to a little bit down, while the VIX is starting to give it a little bit of a bull run. What could that mean? What could be happening moving forward? This is a historically volatile time, everybody. The second year of the 4-year presidential election cycle is historically volatile. This is absolutely normal. If you look throughout history, this is not surprising to a lot of folks that are reading something like this Trader's Almanac. So what are you looking for moving forward? Kevin, I mentioned this before the show. It's spikes in the VIX and how far apart they are. So as I'm looking towards the volatility index, what I'm saying is how long from one spike to another spike? Is it 2 weeks? Is it 3 weeks? Is it 4 months? That's what's starting to tell me a tale of the tape, because as I notice, oh, wait a second, it was 3 months between spikes. Now it's 2 months. Now it's 1 month. That's going to be a little bit more of a concern and capturing a lot more of my attention. Not to say that that's what you should be trading, but Kevin, you notice here you had that big spike up during the taper, or the not the taper tantrum, the tariff tantrum.
Yeah,
in
the
April.
tariff tantrum.
Yep. Then you move out to October, so you got a few months right there, call it 6 or 7. Quick jump past into November. That was a 1 month period. This one's more telling, though. Between that high in November and the most recent one in March, you're at about 4 months. So now we've moved from a 7-month spike cycle into a 4-month spike cycle. Watch out, everybody. If you continue to see spikes going into the historically weak summertime, you could see more movements on the VIX going higher, which would equate, like Kevin mentioned, to an inverse relationship, leading the S&P 500 to go lower.
So absolutely true. And the other thing that stands out to me, Jeff, is there's been, even though we've had the mean reversion, we've not had the mean reversion to our historical mean in the VIX. We are not seeing the VIX pushed back under 20. Take note. When the VIX is elevated over 20, you can anticipate more choppy markets. You can anticipate a lot of volatility. And the thing that stands out, Jeff, we've basically been above the 20 period here. Look at this. Above the 20 period moving average in the VIX all the way back to January. That means the entire year has been an elevation in volatility, and we should absolutely make note of that. Does that mean that any fall in the VIX that brings us close to 22.5 should be one where traders should be positioning and thinking, hey, maybe this is my chance for profit taking on any short-term trades that I've been looking for? Because once the VIX finds support, that could be an area where the VIX fall runs its course, and you might very well witness volatility coming back. So everybody has a plan, usually, as to, not everybody, but many traders utilize a VIX understanding, a relationship with the VIX, as James is pointing out here. Doesn't like longs unless the VIX is less than the 10 period exponential moving average. That's not a terrible approach for some traders, but a lot of you have a defined plan like that. When the VIX is doing this, this is how I act. And I think that that's a perfectly appropriate way to give thought to it. Now, Jeff, we talked a little bit about oil. I'm going to put the chart of oil back up here just briefly as a reminder. The volatility we've seen here this weekend. There was a comment out of the Iran regime, stating that the Strait of Hormuz is wide open except for Israel and the United States. I thought that was kind of an interesting comment. And the thing that's interesting most is that oil pushed over $100 a barrel and has since pulled back. So, Jeff, anything as it relates to oil here is there much more that we can say than what's already known out there?
Sure. Two things I think come to mind here, Kevin. Number one, why did it go to 100? Most likely human psychology. If you notice analysts commenting on different TV and broadcast shows, they mention we could see oil above $100 a barrel. Okay, so that naturally brings $100 into effect as people are looking at their charts. So there's a psychological
Sure.
aspect to what we're seeing right here. The other component that I think people need to note when it comes to oil is the amount of uncertainty that's happening. Now, remember, everybody, the US is actually the largest producer of oil. I don't know if anybody knew that out there. I imagine there's quite a few of you that did. But since fracking became legal during the Bush administration, the US became a net exporter as opposed to a net importer of oil. So the United States really shouldn't see too much effect from the oil levels. Now, that doesn't mean that getting our cargo through that strait is going to be any easier. So there is some credit to
Right.
what's happening there. But Kevin, I don't know that the oil story is really what's driving this as much as it is, wait a second, how do we play the conflict in the Middle East? And that's where I think oil becomes your primary target. If there is a continued conflict, people are just going to start buying more oil. Okay, if people buy more oil, I'm just going to trade that into the bullish movement. If the
Hmm.
conflict starts to dissipate a little bit, well, then I'm going to assume I'm going to start moving out of oil. Similar to the gold conversation, when people think of uncertainty, a lot of folks say, well, let's go into gold. There really hasn't been a historical movement of gold and the S&P 500 aside from what happened most recently, but look back until the 50s, 60s and 70s. Gold and the S&P 500 do not have this inverse relationship like a lot of people want to espouse.
Yeah.
Instead, it's a narrative that everybody gets behind and says, uh-oh, there's uncertainty. Let's jump into gold. I think that may be more what's happening with the oil market right now, but time will tell, Kevin. We'll see if I'm right.
Well, you're right. Time will tell. Give us the best indication of what we need to pay attention to. Our big bounces today coming in from the semiconductor side of things. If I put all my moving averages back up, we'll see that the bounce here has been nice. We're through the highs we made on Thursday, Friday of last week. That's great, but we're still in price discovery mode, still below resistance. This zone here above us where we've had tails into the 20-period moving average, but we've basically been battling it out here approximately at 79, almost 8,000 on this particular index. But Jeff, I think the trend situation here is the call out, right? The action below the 50-day, the number of tails failing in the vicinity of the 50-day. We've basically had one close over the 50-day in the last 2 weeks.
Yeah. Yeah. And you've got what, one, two, three, four, maybe today might be close to five different hits off
Yeah.
that 50-period simple moving average to the bear side. So, yeah, I think that. And then when you have these two movements, meaning the 20-period and the 50-period are both kind of together, that makes that resistance level even stronger for a lot of traders out there. So, yeah, definitely keep an eye on that. Got a comment. Why is gas going up so fast? See also gas company profits. Look at Exxon, look at Shell, look at BP. This is not something that is unusual. If you look throughout history, anytime they have a chance to raise gas prices, they are going to do that. You can also notice this also if you want to give a corollary to another industry. Look at banks. When interest rates start going up, they immediately start charging a lot more money on their loans, knowing, oh, everybody's expecting this because this is what's happening in the overall market. Let's go just a little bit higher. So I wouldn't be surprised if gas companies start to make more profit off of this conflict as opposed to less.
Yeah, interesting. That's not out of the question, is it? Unfortunately, I say unfortunate because that probably means elevated prices are not exactly short term, right? Might be
Sure.
something that
Yeah.
we could see for a lengthier window. Quickly, Jeff, I thought we should
Yeah.
jump over to my Market Watch page. We're going to look at the sector relationships, see where we're getting leadership today. We have it from tech again. part of this could be tied to the fact that we've had such selling that when you get bounces, you get volatile bounces, of course. And once more, I've got to remind us, this is the challenge for us traders. You get these bounces in oversold groups, and the tendency is to believe that the bounce is going to stick longer than you'd think, and that leads us to stick with our positions longer than we'd think. I think we need to be a little bit cautious to that extent. Notice our strongest groups this morning are the weakest on a year-to-date basis. Tech is the leader. Financials 1.4 to the upside, but down nearly 10% year to date. Discretionary is the fourth best today. We are off almost 7% in that space on a year to date basis. Now, industrials is getting a bounce. That's great, but it's the difference here is the industrials is getting a bounce after having a fantastic year to date move, Jeff. It is below the 50-day moving average, but when you're thinking about these spaces, I think the reminder is, yeah, some of these groups are going to get bounces, but maybe just bounces into potential resistance. Jeff, the 20-day, for example, calls out on financials here, does it not?
Yeah, you see the 20-day. And in fact, would you mind putting on the 10-period simple moving average
Sure.
on that? Okay, let's see what happens. All right, there we go. So the 10-period, as you're coming down faster or going up faster, what I've noticed is the market tends to give a little bit more credibility to that 10-period, especially in times of speed. So think almost parabolic rise, parabolic drop. Now that you've got that 10-period on there, Kevin, notice everybody, you've got one, two, I'll call it 3, 4, 5 different hits that we've had since the start of February. What that's telling me is that people are more short-term focused on the financial sector as opposed to longer term, which is what would bring in the 20 period or the 50 period or maybe even the 200 period. So what might a trader be looking for going forward? Well, in the very, very short term, call it a couple weeks to maybe even a month, can we get and earn back that 10-period simple moving average? If we can't, we're going to continue this drop in momentum. The other thing, Kevin, that I noticed, you see how you got that 4 or 5 most recent days, red, red down days, right? Look at the volume, everybody. Increasing, increasing, increasing. Now, on Friday, you had a little bit of help there. You had a red candle, but the volume didn't quite get back up. What could that tell you? Maybe folks are getting tired of the bearish movement. So to see something green today is not unusual. I think that candle, those two bottoming candles right there, that may be where your short-term support comes in to see, hey, are we still tired of this drop on the financial sector, or are we looking for more increased momentum to the downside? And all we needed was a quick breath, and maybe got this movement of the bearishness. You drawing on some Fibonacci's, or there you go.
I was actually thinking just a horizontal support. I mean, if that is going to be support, we could certainly say it's a level at least for 2 days where the selling stopped, right? So the question becomes, can it be support? Do you have anything in historical prices that could validate it as such? That might work out. I mean, you could at least say that much. The selling has been heavy, though, Jeff. I mean, off the peak to the bottom there, financials dropped 14%. That's basically just since late December. That is not an ideal situation here. And the conversation that I'm reading about, at least amongst the financial news outlets and whatnot, is all tied to credit tightening up a little bit and risk associated with private credit specifically, which is risk to banks as well, of course, and then the institutions that are taking the money from those banks. Because, if the banks are at risk and they can't do business, then obviously the individuals to whom they've lent money are going to be on the back end going to be impacted as well.
So well said.
Okay, Jeff. So here we are. We're about, all right, we got about 10 plus minutes to go. I wanted to hit up a couple of key areas in the overall broad market. Specifically, I wanted to look at gold and silver and Bitcoin for everybody. But I wanted to quickly run through here real quick on the rest of the sectors. So quickly looking at energy, which has maintained. So Jeff just got done talking about the 10-day moving average and how confident it can give the shorter-term trend trader a view of things. And energy is a wonderful reversal of what you just saw with financials, Jeff.
I mean, almost the inverse, right? But still that 10 period, very fast moving markets, a lot of credibility being given to the 10 period right now for some traders out there.
So there you have energy. Now, materials has been weaker of late, but could be providing a little bit of a bounce spot if I went with, under my back to my standards. The thing that stands out is the fact that you're a week plus below the 50-day. So maybe a little bit of a breather in a space that had done very, very well. The industrials we talked briefly about, 3 days below the 50-day, getting a little bit into that window where some traders would look for exposure. You are above the high of Friday, potential for a hold move there. Here's your discretionary, trying to hold support. Been a bit of a struggle here, but you can clearly call the ledge that we've settled on here potentially support, and see if that maintains. And then the other one that really stood out to me was healthcare, because healthcare is not holding up the way that I had thought. Now, this is an important level for it. A lot of traders think of healthcare as a bit of a defensive group as well. We've had leadership from defensives like Staples and Energy, but healthcare was good at the beginning of the year, but the last couple of weeks, Jeff, here have been kind of struggling.
Yeah, people getting just a little bit nervous, but you're right. His healthcare more of a defensive sector that generally does well as you're coming into the later parts of the business cycle. So to see it coming down, I'd want to dig a little bit deeper. This is something, hey, I don't quite yet have enough information to make a call on. Let me do some research and then I'll figure out what the narrative is.
And then, Jeff, the two that are interest rate sensitive, utilities getting a bounce today with the yields falling a bit. And then real estate, given this is an interesting one, I thought. This looks pretty technical 101 stuff, Jeff. Breakout from a range, held for 9 months, went sideways, broke out, thrown back to the range for support test.
Yeah, kind of what you'd expect. Very textbook. I think you said it well, Kevin. So what are traders looking for? Well, do we continue to hold that support, which the market would say for those of you that are technicians out there? Well, the fact that we came back to test our previous resistance would lend more credibility to that being the support level moving forward. But watch out for that orange 20-period simple moving average. I don't think that's done yet. That may have a little bit more to say about this trend, Kevin.
Yeah, good chance, right? I mean, don't forget, overhead resistance isn't overhead resistance in perpetuity. It could be a scenario by which we see a rally into the 20-day, a breather, a pause, 1 day, 2 day, a week, what have you, before moving higher. So resistance isn't always resistance forever, as a good reminder. Okay. Jeff, let's hit those futures. Again, we noted that the futures not being appropriate for all traders, but I like to use the futures just as a reminder of what we need to be paying attention to from a trend standpoint. Pretty clear what's going on with gold all of a sudden, Jeff. Look at that 50-day moving average.
Gosh, tons of attention right there. So when you're looking at something like gold, what are you thinking about? What's the narrative? What are people looking at as they go, okay, now we're going to hold this 50-period simple moving average? As we look at silver, I know silver hasn't healed quite as well as gold has on this pullback, but I'm more curious on what your thoughts are, Kevin.
Well, I think if you're a trend trader, you're getting evidence that you can work with, right? You could absolutely look at the 50-day and say, boy, under the 50-day, I can't be as confident as I want to be. Look at silver. You're absolutely right. The difference in gold and silver is pretty stark here, Jeff. I'm wondering if there's a different moving average we should be looking at. Maybe, is there a 100-period beneath us? Okay, so maybe silver is a little more long range move here, having made dramatic move to the upside and come back aggressively, right? We had basically an incredible push to the upside, 100+%, sold down about half of it. I think that you go with the one we often say, Jeff, if we're trend traders, we go with the moving average that's respected by the instrument. Currently, it'd be the 100-day on the silver, it would seem, and then on gold, it would seem to be the 50-day. And again, it's just a matter of risk mitigation, right? Doesn't mean you couldn't work with the 100-day on gold. It just means if you worked with the 100-day, you're admitting you're willing to risk, what is that, about 500 points to the $500 an ounce to the downside, Jeff? That's about a 10% situation, right? Not everybody wants to stick with it for a 10% support test.
Yeah. Hey, real quick, I want to share a story with everybody about the importance of having a trade plan. Would you mind pulling up silver for us, please? So I was talking to a client.
What are you looking for? I'm sorry.
Silver.
Silver, yeah.
Silver futures. So I was talking with a client, and this young man had bought a leveraged product to try to play what was happening in silver. He put $400,000 of his $700,000 account into silver back in November. Not a bad time. Used a contract that would go all the way out until April. Now, This young man turned $400,000, I kid you not, everybody, into 24 million right at that peak.
Wow.
400,000 into 24 million. Not bad, right? So what do? I reach out, say, hey, great trade, really nice job. What's your plan? How are you going to get out of this contract situation? And this, unfortunately, came to my attention on that Thursday before the drop. So what day did I reach out? Friday. Friday, 24 million was now down to 12 million. This individual had said, you know what? I'm still confident. I like what's happening. I'm not going to change anything, meaning they didn't take a single dollar off the table. 12 million turned into 8 million, 8 million turned into 5 million. Then you get kind of this little bullish movement here, what we like to refer to as the bull trap. 5 million went back up to 8 million. He continued to hold on to this levered product. 8 million is now down somewhere around $4.5 to $5 million. Now, why do I bring this up? Because of the importance of having a plan before you get into the trade. This individual got very lucky, and a lot of us are very fortunate to have these lucky movements from time to time. But I encourage all of you, when you're looking at trading something, every trade you take, consciously think, why am I in this trade? And when do I get out? If he would have done that, I think he would be sitting on a few $1,000,000 more than what he currently has. And by the way, Kevin, he has not changed any of the positions last I checked.
That is any kind of advisor in the financial markets, that is one that hurts your heart, doesn't it, Jeff? Because you know that there was an opportunity to capitalize, and by virtue of the fact that we didn't have a plan that made it easy to take action, man, it's tough. I say it all the time, Jeff. It's not a scenario by which you need a plan because you're going to lose money. You do it because you want to be prepared to act when things that you don't know are going to happen actually happen. It's really, really hard, even when they're going great. When it's going gangbusters, 500,000 into 10 million, 20 million, what have you, doesn't mean it's going to be easy just because you're looking at profits, right? If you're unprepared, it is exceedingly difficult. You will become emotional. There's just no way around it. Jeff, I wanted to look briefly at Bitcoin. Bitcoin's been on a struggle bus of late. Now, we are seeing most recently this push to highs we've not seen. Bitcoin now trading at a 1-month high, actually a 6-week high. If I put the 50-day moving average on there, could that be an area for a potential short-term target? I think a lot of traders might suggest yes.
Yeah. I think that's probably where a lot of folks are eyeing that up. That also correlates a little bit to that helper that you had, the support in orange, that was saying, okay, what are we at? Somewhere around 88,000 or so. So what are you going to be looking for if you're going to be trading Bitcoin? Well, if you're to the bullish side, you've got a little bit of pop potential where, okay, maybe we make it up to the 50-period simple moving average. That is your potential reward. What is your risk? I don't know that, Kevin, if you're looking at this, if that's my reward and my risk is coming back down to our previous lows, that seems lopsided. Generally, you want to have a 1-to-3 risk to reward. In this case, I think you've got more of a 3-to-1 risk to reward. I don't know that a lot of traders are going to be jumping on that train.
Yeah, I'm going to agree with you. Risk to reward at the moment favors bears more so than bulls because the downtrend is in place since the peak we've had in October. A trend as in the current level is more likely to continue than to break, and that means that while there might be upside into the downtrend line or the 50-day moving average, that upside is limited relative to where the downside could be, meaning if this is a downtrend that is going to continue, then the bear expects any rallies into the downtrend line, into the 50-day moving average to be sold. And if that's the case, they then expect a lower low, or at best, I should say for the bulls, at best, a matching low at the level to which we have already traded, which would be the 60,000 ledge down below. So risk factors, risk versus reward favors bears at this point unless we get a breakout above the 50-day moving average. And I'll point out, we did that recently back there in January, Jeff, but if you had a plan and a validation of what you determined to be confirmation, Jeff, you could have probably saved yourself a little bit of a headache there, as we were only above the 50-day for about 3 closes before the reversal.
Yeah. I don't know that would have been enough for a lot of traders. That's 1-2 closes, and you go, okay, maybe we've got something here. That third day happens, and you're going, yeah, a little less confident than I was just a day ago. So yeah, I like what a lot of us are saying. Plan your trade, trade your plan. Remember, it's about risk. That's really what you're focused on as a trader. It's not so much the
Yep.
reward part; it's the risk component.
Well, we love to make money, but we also like to not lose money. And the job of a trader, while it is to make money, it's also to preserve capital. And hence the discussion around trade management, planning our trades and trading our plans and so forth. I wanted to also mention as we wrap things up here, everybody, there was an announcement here on a company that's been a little bit in the news of late, Nebius, NBIS. Just today, they announced a new long-term deal with for AI infrastructure supply agreement with Meta, strengthening their collaboration between Meta and NBIS. And of course, NVIDIA this week is holding their conference. So there's been some optimism and notation there, or sort of detail there. So pay attention to what's happening with NVIDIA. Inevitably, of course, as NVIDIA goes, it can drive the market. It's really been a tight market of late in NVIDIA, Jeff. I mean, yes, it's got big swings, right? But it's not really going anywhere these last couple of months, has it?
Big sideways trend right there. But we were going all the way back to the summer months. It tried to break out, couldn't do it. Just loving that 50-period simple moving average, I think, for a lot of traders that are keeping an eye on this. So we'll see what happens during that earnings announcement. Sure, it's the largest component of the S&P 500. Kevin, I don't know that a good earnings announcement, even a great earnings announcement, is going to be enough to really pull us out of the bear movement that we're having. But ultimately, time will tell on that one.
Yeah, you're right. I was just applying the Bollinger Bands to see if it was as sideways as I thought, but not quite. It looks like we had the tightest or the lack of volatility here back in January, and our expansion to add volatility really didn't stick, So we've basically continued to go sideways as volatility has kind of left this position, and holding the 200-day kind of stands out. But an interesting week, it's volatility, but nonetheless, NVIDIA in the headlines due to their conference and all that. So plenty to keep your ear to the rail, and plenty of reason at least to keep it tuned to the Schwab YouTube channel that we call Trader Talks. So as always, Jeff, a big thank you to you for being here. Love having you. I wish I could get you more than once a month, but I wish I could get all my co-hosts more than once a month, as it turns out. But I do love having you, Jeff. Thanks for being here, buddy.
Thanks so much for having me, Kevin. Always a pleasure. A lot of fun today. Thanks, everybody.
Absolutely. And to all of you, thanks for being here. Big thanks to Brent in the chat. Follow us on X. Hit that thumbs up button for us down below, and make sure you're subscribed to the channel, everybody. Have a great rest of your Monday. We'll catch up with you again real soon.